Now, overnight, we got more disappointing news out of China. China's official factory gauge fell to the lowest level in 3 years. China's Purchasing Managers Index, the PMI, came in at a reading of 49.7 for the month of August. That was down from a reading of 50 in July. Of course, numbers below 50 indicate a contraction. The Shanghai Composite, the equity benchmark there, closed down more than 1% today. Here to make sense of the numbers is Simon Mail. He is the head of Asian equity sales at Auerbach, Grayson and Company. And still with us on set, Bloomberg Stocks editor Mike Regan. Simon, thanks so much for coming in this morning. So we are now seeing the biggest equity sell-off in China since 1996. We are seeing the economy growing at the slowest rate since 1990. Is this the hard landing we were all so afraid of?
I wouldn't say it's a hard landing, but it's certainly an issue that I think growth is disappointing in China. We've seen the weakest number in 3 years, as you said. The concern is whether the Chinese policymakers have the tools in their arsenal to combat this. We've seen 5 interest rate cuts since November last year. At the same time, we've seen growth fall steadily. The concern is whether the Chinese economy is going to react to these interest rate cuts. Interest rate cuts are going to work if you have companies that want to borrow and want to invest. What you have in China at the moment is a situation where you have very weak external demand, we have very weak internal demand, you have overcapacity in many industries. If you're a company, you're not going to invest simply because money is available if you're already facing an overcapacity situation. So the other concern is on the demand side of the equation. I think in the West, we're used to seeing lower interest rates as a stimulus to consumer demand. People pay less on their mortgages, people pay less on their credit cards. Chinese consumers are just simply not indebted and leveraged in the same way as American consumers
Not yet.
Not yet. That may happen at some point down the road, and I think it inevitably will happen. But it's not happening at the moment. So simply by reducing interest rates, you're not going to stimulate consumer demand. So you have this very difficult situation where you have an enormous economy going through a massive transition. And you also have an economy that is steadily deregulating as well. So that raises the other question, is whether the government can indeed direct the economy in the way that they wish. So I think there are very valid concerns all around, yeah.
What does the government need to do to stabilize the sell-off in the equity market and to stabilize the slowdown in the economy? What further steps do you expect to see Beijing take, whether it's fiscal or monetary policy?
I think in terms of the economy, I think they're doing the right thing. They're steadily reducing interest rates. What you don't want to do is create a massive bubble again like they did in 2008. You don't want to have a massive cut in interest rates and that to feed through to a property market bubble or some kind of problem. The Chinese authorities are very, very wary of that. I think they're doing the right thing. They're taking measured steps, and they're gradually seeing whether those are working. I expect you to see more cuts in interest rates. And they're also doing the right thing in other bigger picture measures, trying to boost rural incomes, to reform state-owned enterprises, financial liberalization. These things are going to work, but they're not going to happen overnight. The markets are very impatient at the moment. They want to see the results of this change. It's not going to happen. It's going to be a very slow transformation. In terms of the market, my own opinion is the best thing they can do is just step back. I think the intervention that we've seen so far and the intent...
So they shouldn't come in. They shouldn't come in trying to buy large cap equities. They shouldn't try to,
I believe in the long run that's just going to be counterproductive. I think what that's going to do is actually scare away foreign investors. China wants to liberalize their stock market. In the long run, they want to encourage foreign participation in the stock market. If simply what they're going to do is try and guide the stock market and support the stock market, I think that's going to scare away foreign investors.
Simon, a lot of people are very skeptical of the official economic statistics that come out of China. I mean, should we be, and if so, are there other metrics to look at? I don't know, iPhone sales in China, stuff like that. What's the best way to really...
Power usage, perhaps.
Power usage and cement production are very useful gauges of economic activity. But they're gauges of economic activity for an economy that is being manufacturing-led and then being fixed-asset investment-led. Clearly, as you move to more of a consumption and service-led economy, power usage and cement are just not as relevant.
Well, correct me if I'm wrong. The power numbers show growth of 4.5%.
I think it's even weaker than that, to be honest. I think power consumption has actually been declining. Again, I'd need to go back and check the data. But in terms of whether we believe the absolute level, I agree with you. We simply don't know. I mean, I think there's a lot of skepticism around the unemployment numbers in China, which have held steady at about 4%. It seems implausible that you've had this big slowdown in manufacturing, and yet there have been no layoffs. But I think the important point is simply we need to look at the direction, right? We're seeing deceleration, but we're starting to see stabilization as well. At what level, I can't tell you.
So is this the bottom?
I don't think this is. I think things are probably going to slow further. As I said before, lower interest rates are going to feed through to the real economy with a lag. The cuts we started seeing in November could take 12 to 18 months to feed through. And that's exactly the point. The Chinese government does not want to overcut interest rates to overstimulate. They're trying to see the effects of that. And I think they're probably doing the right thing. If we see weaker numbers, they will continue to cut. So I think you will see growth continue to weaken.
Mike, let's bring this back to the U.S. equity markets right now. We're showing these banners of these huge market movements. We're seeing gold jumping to a one-week high, a lot of money pouring into the Treasury market and equities selling off. The question everybody's still trying to figure out, how exposed is the U.S. equity market to the slowdown in China?
Well, I think I'm guessing the correlations between the two are exaggerated from how much it really matters. You know, I guess, Simon, my main question to you is this. How much is this big drop in the stock market in China, that paper wealth being pulled away from these people, is that a big concern, or was it, money that they, imaginary money that probably is not affecting confidence too much?
I think it's a big concern for people who lost money, but the important point is the people who lost money, I don't think, are a meaningful part of the overall economy.
Right.
Now, they are the wealthier people in China. They are the people who've been buying iPhones. They are the people who've been buying BMWs. They are the people who've been buying expensive
cognac. We also hear often
cognac.
that they are people who haven't gone to college, who are getting stock tips, from hawkers on the sidewalk.
Well, that's true as well, but I think you need to look at the degree of participation in the stock market in China is still relatively small. I think it's about 6 or 7% of people have stock trading accounts. So I think there's very valid reasons for being concerned about luxury consumption in China. It's the wealthier people who are losing money. There were reasons to be concerned before that. There were reasons to be concerned because of the anti-corruption program in China, and we saw this slowdown in luxury consumption before this. The downturn in the stock market has exacerbated that. Now, the question is are there reasons to be concerned about broader consumption in China, not just at the luxury level? In terms of broader consumption, retail sales still growing at 10, 11%. So I think,
So the crackdown on conspicuous consumption, the crackdown on graft, perhaps not filtering down to the more middle-class consumer.
Right. Those people were not involved in the first place. But, yeah.
Is there a reason to is there reason to find optimism in the fact that actually that manufacturing is slowing, because everybody says that what China really needs longer term is for the economy to rebalance, for there to be a greater weight on services, which are still expanding, and less weight on manufacturing? Maybe this is all a healthy rebalancing. It's
a healthy rebalancing. And I mean, to go back to your point on climate change, one of the reasons we've probably seen an exacerbated reduction in industrial production this month, China has been very, very keen to reduce greenhouse gas production from their old smokestack industries. They've been deliberately curbing production from steel plants, from cement plants. They're old and they're inefficient. So, yeah, it's all part of an ongoing transformation, and I agree with that. The question is, markets are very impatient, as I said before, and this is going to be a long-term transformation, and we're going to see some pain before it comes out the other end.
Are they paying attention to Donald Trump in China?
That I can't tell you. Sorry. I mean, he's certainly known, but whether they're paying attention in terms of what he's saying, I can't tell you.
I was going to say, every time they need to have a parade, they tell all the factories around Beijing to turn off the taps.
Well, that's true, and I think there's a big parade this coming weekend.
Exactly.
So that's a concern. Yeah.
Come Thursday.
Yeah.